Tesla stock is up nearly 50% over the past month. The stock rallied 40% in the days following Trump's election win, before finally selling off 6% on Tuesday. Tesla has now crossed $1 trillion in market cap again, making it the 8th most valuable company in the world. Elon Musk saw his personal net worth grow by $70 billion, hitting a new high of $304 billion. Virtually all of Musk's worth comes from his ownership in his businesses, and as the largest owner of Tesla, Musk sees the biggest increase in absolute value. However, countless others benefit from this value creation. Many Tesla employees and early investors have become multi-millionaires by sticking with Tesla stock over the years. I love to follow great success stories like this. For example, Microsoft, since its 1986 IPO, created 8 billionaires and an estimated 12,000 millionaire employees. Both Microsoft and Tesla will likely continue to create more millionaires in the future. Ownership in great businesses is an excellent path to wealth creation. Personally, I've benefited from the growth of Tesla stock, albeit not to the millionaire level. Tesla is actually my largest individual holding across all my investment accounts, while not in the dividend growth portfolio I typically show on the channel. Overall, I'm up 238.43% with a total value of $67,668. That's $47,673 of unrealized gains. My first Tesla purchase all the way back in 2016 is up over 2,000%. That's $23,468 of gains, all from an $1,100 investment. My biggest mistake was not buying more Tesla stock in 2019 when it was actually at the same exact price. And then I had $10,000 on the sidelines and just never pulled the trigger. That's $240,000 of missed value. And that backs up the old Warren Buffett adage, which is that the biggest mistakes are the mistakes of omission, where you know enough to act, but then sit there sucking your thumb. And I definitely knew enough to buy Tesla stock at that point. Even if you don't own Tesla, it's a sizable part of popular ETFs like the S&P 500 index and the NASDAQ 100 index. Tesla is currently 1.76% of the S&P 500, making it the 7th largest position, and it's currently 3.76% of the NASDAQ 100, also at the 7th highest position. Those funds are core parts of millions of retirement accounts, so you may benefit from Tesla's growth without even knowing. Microsoft, Tesla, and many other companies also provide a lot of value in the real world. That is how they become valuable. They make products and services that provide value. With Tesla, you have high-quality electric cars with innovative new technologies becoming increasingly more affordable, plus the fastest and most available electric charging network. Also, you have the market-leading battery storage to act as a battery backup, store and sell solar energy, or help live off the grid when combined with solar panels, plus industrial-scale energy storage to help stabilize and expand the grid. These are real things, and Tesla may just be getting started. In the coming years, we have the widespread adoption of self-driving, which has the chance to save thousands of lives a year and truly change the whole transportation industry. And we don't even have to go into the whole Tesla bot potential over the next decade. Now, I know that Tesla and Elon Musk have become one of those things that's viewed through a highly political lens. And based on my last Tesla video, it seems like many of you hate him. And I suppose you're allowed to have that opinion, but let's just take a step back and look at the world in the big picture. The creation of a company like Tesla should be celebrated. Its successes should be celebrated. In our free market system, the overwhelming majority of large corporations become valuable by providing value to society. In recent history, that includes big winners like Nvidia. That created countless millionaires as well. And it did that by creating a vital piece of infrastructure to bring machine learning and AI to the world. That is value creation. But just because Tesla stock is going up and has long-term potential, that does not mean it's time to buy right now. From the perspective of a long-term investor in Tesla, the recent stock price surge is not something to get excited about. The stock is actually more risky after going up 50%, not less. Today, I'm going to do an updated stock analysis on Tesla and explain why you should be more cautious after this recent run-up in stock price. I'll explain this recent phenomena using Warren Buffett's Mr. Market analogy he got from Ben Graham. Then I'll analyze the latest earnings report at Tesla, discuss bullish and bearish price targets, and share a story of short sellers losing over $5 billion this week betting against Tesla stock. If you stick around to the end, I'll share what I think about this popular tweet where someone said, "Tesla will be the greatest dividend stock of all time." It should be noted that they do not currently pay a dividend. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I'll be using my stock research tool, which is available at dividenddata.com. I just recently put out a great new feature, which is our AI investment analyst. Think of this as ChatGPT, but specifically trained to give you answers on stock analysis. And I'll use this throughout the video to help with my Tesla stock research and even get price targets and do discounted cash flow analysis. And I keep finding new and useful ways to use this AI tool. So frankly, it seems like the limits are your imagination at the moment. I want as many people to try this as possible, so I'm doing a special 50% off sale for dividenddata.com that applies to both the monthly and annual plan. Use the promo code AI at checkout if you sign up via the web app, just the 2 letters AI, or click the link in the description and pin comment to get the sale directly. No promo code needed. There's a 30-day money-back guarantee, so feel free to try it out. And remember, you can lock in that discount for life. Oh, and be sure to join our Discord community and share with me any useful prompts you find. Let's get to the video. Now, you might notice that I have a very good cost basis on Tesla stock. I've increased my position over the years, but I've been very diligent to only buy at times where I think the stock is trading at or below fair value. So my current cost per share of my recent buys is $143.71. And the bulk of that was purchased in January 2023 and in spring 2024. And personally, I would not buy Tesla stock at the current prices, but I also wouldn't bet against it. And that's because Tesla is a real growing business that's highly innovative, and the future of Tesla is going to be much larger than the current reality. Tesla stock is extremely volatile. A 6% change in one day is normal. And while this 50% run up has been quite extreme, it really isn't that crazy in the historical context of Tesla stock. Tesla is still not yet at the 2021 high of $410, but that price was extremely overvalued for the time. Since then, Tesla has continued growing and developing as a business. Their technologies like self-driving are further and farther along, but this is really the important part. You should look to the business in order to value Tesla stock and not look to the stock price. The stock price should not inform your opinion on the value of Tesla. This is the same of any business. The stock market in terms of pricing can often act irrational and highly emotional. That can be true on the downside and on the upside. I'm going to play this clip of Warren Buffett about how to think about stock market volatility, and I think this is really important to have in our mind when talking about Tesla stock today. Sorry for the blurry video, by the way.
In light of recent stock market volatility, could you give us your definition of stock market risk?
We don't think in terms of, we think first in terms of business risk. The key to Graham's approach to investing is not thinking of stocks as stocks or part of a stock market. Stocks are part of a business. People in this room own a piece of a business. If the business does well, they're going to do all right as long as they don't pay way too much to join into that business. The stock market is there to serve you and not to instruct you. And that's a key to owning a good business and getting rid of the risk that would otherwise exist in the market. You mentioned volatility. It doesn't make any difference to us whether the volatility of the stock market, is that averages 0.5% a day or 0.25% of a day or 5% a day. In fact, we'd make a lot more money if volatility was higher because it would create more mistakes in the market. So volatility is a huge plus to the real investor. Ben Graham used the example of Mr. Market, which is we've used it. I've copied it in the report. I copy from all the good writers. And Ben said, just imagine that when you buy a stock that you bought into a business where you have this obliging partner who comes around every day and offers you a price at which you'll either buy or sell. And the price is identical. And no one ever gets that in a private business where daily you get a buy-sell offer by a party. But in the stock market, you get it. That's a huge advantage. It's a bigger advantage if this partner of yours is a heavy drinking manic depressive. I mean, the crazier he is, the more money you're going to make. So you should, as an investor, you love volatility. Not if you're on margin. But if you're an investor, you aren't on margin. And if you're an investor, you love the idea of wild swings because it means more things are going to get mispriced.
As an investor, you should actually love the idea of volatility. Using Warren Buffett's logic, volatility in stock price is not the same as risk. The real risk when investing is business risk, as in something that would help or hurt the economic realities of a business. So despite massive volatility over the past month, the actual business risk of Tesla has not increased. Stock market volatility can actually help the long-term investor as it creates opportunities. And Tesla is an extremely volatile stock. And throughout its history, it's created buying opportunities for me. And if I was to trade, it possibly created opportunities to sell even, like in 2021. And this current run-up in stock price is a little closer to that sell territory if you were a trader. I'm not going to do that personally, but at a minimum, you should not get any fear of missing out from this recent run-up in Tesla stock. It is less attractive to buy after this recent run-up. Tesla is a real business with real earnings. Tesla's revenue per share has grown at a 39.10% 10-year compound annual growth rate, and during that time, free cash flow has gone from being deeply negative to positive. In the latest quarter, Tesla generated $2.7 billion of free cash flow, and that would be even more if they weren't investing so heavily into new factories and AI data centers. They spent $3.5 billion on capital expenditures. In Q3, cash from operations was $6.26 billion. In fiscal 2023, they generated $13.2 billion in cash from operations. Their balance sheet continues to improve as they now have $69.9 billion in shareholder equity, $33.6 billion in cash and short-term investments, negative $20.8 billion of net debt. As a business, Tesla is in an extremely good financial position. The main negative comes from their decline in earnings over the past year as they reduced prices on their vehicles, hurting margins. But they did this for long-term business reasons of wanting to sustain and slowly grow vehicle production and sales, which they did during this time. While all of their electric vehicle peers actually had declining sales, it should also be noted that Tesla is the only profitable electric vehicle maker. And in the latest quarter, they had 19.8% gross margins and 8.61% net margins, which is very strong in the automotive business and really most large manufacturing businesses. And if we look at the categories Tesla operates in, every single one is a long-term growth business. Electric vehicles, battery storage, and electric vehicle charging are all growth businesses. Since 2020, automotive sales have grown from $24.6 billion to $78.5 billion. Energy storage revenue has grown from $1.9 billion to $8.4 billion over the trailing 12 months. And services revenue has grown from $2.3 billion to $9.8 billion over the trailing 12 months. So all of their current business segments are growth businesses over the coming decade. And after a weak 2022 and 2023 in terms of car production and deliveries, Tesla is finally re-accelerating growth again. Total production saw a 9% year-over-year increase in Q3, and total deliveries saw a 6% year-over-year increase. Energy storage deployed grew at 75% year-over-year, and superchargers grew over 20% year over year. On the latest earnings call, Elon Musk said that he expects 20 to 30% vehicle sales growth in 2025, barring any major external events. They also bragged about having delivery growth while the overall industry saw year over year declines in volumes. They're expecting their new Cybercab to reach volume production in 2026 with a target of at least 2 million units per year. However, the biggest bull case around Tesla stock is AI and autonomous driving. And they are saying that according to their data, they're on track of achieving better than human performance by Q2 2025, and they are planning to roll out ride-hailing services in California and Texas next year, pending regulatory approval. So next year, Tesla is about to start an entirely new growth business. Self-driving over the next 5 years has the potential to grow into Tesla's most profitable segment. And over the long term, Tesla is also heavily involved in robotics and believes that their humanoid robot Optimus will be a huge business. Elon Musk has said this multiple times, and on the Q2 earnings call, he said that he believes the long-term value of Optimus humanoid robots will exceed that of all other Tesla's businesses combined. And knowing Elon, this may be directionally correct, but it could be 5 to 10 years later than he might think it is in his mind. But who knows, by 2040, maybe that's right. In Q3, Elon Musk said that Tesla is focused on building the future of energy, transport, robotics, and AI with the goal of becoming the most valuable company in the world. And some people may call me crazy, but I think that is possible, actually probably likely over the next 10 to 20 years. And that's why Tesla is one of my long-term growth holdings. I plan to hold my Tesla stock for decades assuming they don't have any major business risks that come up. But what is a reasonable valuation for Tesla stock today? Among current analyst price targets, the average price is $227.26. The current high price target is $400. And I'll actually play the clip of the guy on CNBC who just gave his $400 price target. And you have analysts all over the map, from underperform, outperform. The plurality are at hold. That's 19 who say hold. You have 7 at sell, 12 at buy, and then 8 at no opinion. And no opinion is actually probably a very reasonable take to have on Tesla stock, because in terms of financials, it's extremely difficult to value doing a discounted cash flow analysis, which is the primary way how most people analyze stocks. Speaking of discounted cash flow, let's take a look at it. So this is the default data that my AI investment analyst put in for doing a discounted cash flow analysis on Tesla stock. They assumed 3% revenue growth in fiscal 2024. We've already had the first 3 quarters, and that's around accurate. They're assuming 16.35% in 2025, which I think is a little under, and 17.8% in 2026, which I would also say is under, and then 0 for 27 and 0 for 28. So this is definitely on the conservative end. However, they defaulted to putting an exit multiple based on free cash flow of 195, which is just ridiculous. And based on that, they got to an implied share price of $154.47, which is a 55% downside from here. But I'll play around with this for a second to see if I can get a little more accurate. Now let's remember that Tesla at one point was growing 50% at least a year, and they grew 70% revenue in 2021. And we're currently re-accelerating and expecting 20 to 30% growth in vehicle sales in 2025. So I'm going to assume 25% revenue. Let's also remember they're launching their self-driving taxi service slowly in 2025. And I am going to have that re-accelerating in 2026 and 2027 and 2028. And I would actually say this is conservative, but I'm going to say they average 35% over those 3 years. So by the end of fiscal 2028, they would have over $300 billion of revenue, basically adding $200 billion over these 4 years. And if we use their exit multiple of expected value to free cash flow, which was default at like 195, which is ridiculous. If we use that number, their implied share price is $334, which is only slightly above the current price of $328. And if we just lower that free cash flow multiple to something a little more reasonable, like even 80, which is definitely on the high end and only reserved for extremely fast growing businesses, that would lower the implied share price to $144, a massive downside. I may have to play around with some of these numbers because you can also edit margins, tax rates, capital expenditures, and other factors. And by the way, if you want to play around with this yourself, then all you have to do is go on dividenddata.com, type in a stock and ask for an intrinsic value calculation or discounted cash flow, etc. But as I mentioned earlier, the highest price target is $400. And let's listen to the interview of the guy who went on CNBC and just announced he was raising his price target to that. Dan Ives. This is the tech guy you'll usually see on CNBC. He talks about Apple a lot.
Welcome back. Tesla shares popping yet again today, continuing to add to that post-election pop. My next guest calling President-elect Trump's victory a, quote, game changer for the EV maker. He's raised his price target now to $400 from $300. Joining me now, Post 9, is Wedbush's Dan Ives. He is now the global head of technology research, a new title, a fancy new title to go with your jacket. Welcome.
Thank you.
Congrats.
Thanks.
All right. So why is this a game changer beyond the obvious of what people have seen thus far? This, what is a new and cozy relationship now between President-elect Trump and Elon Musk?
Yeah, I think it's the autonomous piece. I mean, if you look at full self-driving autonomous, I could argue it's the most undervalued AI play in the market today. And I think autonomous cyber cab and the timing, I think could get accelerated 2 to 3 years. And that's important in terms of from the sum of the parts, the stock, that could add $1 trillion of valuation alone. And you could be looking at 20, 30% more revenue per year that you even see today.
You think $2 trillion valuation over the next 12 to 18 months is reasonable?
I think it's conservative, potentially, if they actually execute on the vision that I see, not just in terms of autonomous and AI, but really it's more about that software penetration within Teslas from an FSD perspective. Mm-hmm. It changes the whole business model. The biggest regulatory issue that they've had to navigate from an autonomous perspective, a lot of that now starts to dissipate. And that's a key part of the value. I mean, I ultimately look at this as unlocking $1 trillion of value in Tesla, AI and autonomous.
Simply because of Donald Trump's win?
Simply because of Trump's win. Because Trump's win changes the whole game for Musk, for Tesla, for autonomous, for FSD. They'll still have issues on states. This is not going to be, 100% smooth road. But this is a much different stock than it was a week ago.
As I mentioned, a lot of the bull case for Tesla stock depends on how big of a business autonomous driving and a self-driving taxi network ends up being for Tesla, and also how soon that happens. And a big part of this run-up in Tesla stock is people assuming that that will be sooner now. And I think that probably is the reality. I also think his prediction of a $2 trillion market cap over the next 12 to 18 months is not that crazy either. For that to happen, they just need a successful rollout of their self-driving taxi network, some real economics behind it, and maybe a quarter or two of results, and a clear path forward to approval across all these different states, and ultimately across the entire United States. And at that time, there may be some analysts with some wild price targets as they try and forecast what the economics of that business will be. And I like to be very conservative with my purchases of Tesla stock, so I only buy it when it's very undervalued or at a margin of safety. I do not chase this at all because of how volatile it is. So I definitely would not buy Tesla at the current price. But I also would not short Tesla stock either, even if I think short term it's on the overvalued side. And that's because I think it's far more likely over the long term that Tesla stock goes to that $2 trillion number than I do that Tesla stock could fall to a $300 billion valuation. Shorting Tesla has always proved to be a terrible idea. And you just had hedge funds lose $5 billion over the past week shorting Tesla stock. And here's an interesting Bloomberg interview talking about that and why shorting Tesla is a terrible idea.
According to Bloomberg calculations, hedge funds that had short positions against Tesla between election day and Friday's close took an on-paper hit of at least $5.2 billion. Let's bring in Bloomberg's David Welch in Detroit. I mean, this has been the calculus for some time, but that time period and a $5.2 billion loss is quite something, David.
It is. Look, people have lost money trying to short Tesla and bet against Elon Musk for a long time. But in this case, I think the bet was that his whole robo-taxi plan, turning Tesla into an AI company, either wouldn't happen or wouldn't happen on time. So there would be a lot of bad or delayed news on Tesla, stock would go down and the shorts would do well with it. When in fact now you've got this tight relationship with Donald Trump, that means you'll see EV policies probably that are crafted to help Tesla. And more importantly, you'll probably see some sort of permissive federal framework for autonomous vehicles that will also help Tesla's plans for robotaxis. And investors like that, they're willing to bet on that. And the shorts, they got hit hard. I think there's some still in there who are thinking that Trump will gut some of these IRA credits and things that help EVs sell. And if Trump had a lawsuit against the state of California before, and if that happens again, if it's successful and you get rid of some of these clean air credits that other companies have to buy from Tesla, which is a very profitable part of Tesla's business, if that shrinks because of this, then it could work against the company, a Trump presidency. But again, you've got Elon Musk sitting next to Donald Trump, talking to him about policies for this things. It's hard for these kind of things. It's hard to imagine he's going to suggest that Donald Trump do anything that's going to hurt clean air credits, that's going to hurt IRA credits and other things that will help his company.
I disagree with that last part about Trump not getting rid of these credits, or Elon Musk telling him not to, because Elon Musk himself has publicly come out against these EV tax credits, and he says he doesn't think Tesla needs them. And the reason why he says that is Tesla is actually a profitable business. They don't really need these credits to fund their future growth. And purely if you were thinking of this as a battle of the businesses kind of market share battle, then getting rid of EV tax credits hurts all of Tesla's competitors way more than it hurts Tesla. Rivian would get crushed by that. The EV businesses at both Ford and General Motors would get crushed by that. All of those companies have deeply unprofitable electric vehicle businesses. So in terms of market share, if you got rid of all these credits, Tesla's market share in EVs would go continue climbing up. It'd be way worse for their competition than it would be for Tesla. Plus the main value creation for Tesla over the long term, they're going all in on self-driving. They just want to produce as many vehicles as possible. And while they want to make money on the cars, they've said in some earnings calls that that they're less concerned with margins, which is why they cut prices in 2023 and 2024 on all their vehicles. They're trying to get costs down as much as possible. And the entire game with Tesla stock is cumulative miles driven with full self-driving. They just want to collect as much data as possible. They now have over 2 billion miles driven with full self-driving and over 1 billion miles with full self-driving version 12, which is their new version completely based on neural nets. And Tesla has mentioned this many times. They just view each car out there as a little data collection machine, and it's all used to help them solve full self-driving. But this also brings back to why it's so hard to value Tesla stock, because the economics of that future business and entire world are very unknown. That's why I only buy Tesla stock when it's trading at what I think is around fair value, or ideally far below fair value. I do not chase the valuation on Tesla stock at all. And it is a very different type of business than many of the other ones I invest in. I usually like to focus on high free cash flow generative companies with growing dividend payments, and typically those have more mature, defined businesses. Tesla basically acts like the largest startup on earth, and they're a $1 trillion company that's tinkering on ideas for humanoid robot businesses that they think will be bigger than their entire company currently. It's a very different kind of investment. But I did just see this tweet that got 330,000 views. It said Tesla will be the greatest dividend stock of all time. And that may seem ridiculous given that Tesla does not currently pay a dividend. But if you were to think about this over 20 to 40 years, this may not seem that ridiculous. After all, what does it actually mean to be the largest dividend payer? It means to have the largest amount of dividends paid. And how do you do that? You have to generate the most cash. So who has the highest cash from operations? I asked dividenddata.com to filter US stocks by the largest cash from operations, and I sorted it. And first we have Microsoft at $118.5 billion over the trailing 12 months, Apple at $113 billion over the trailing 12 months, and surprisingly Amazon at third with $107.9 billion over the trailing 12 months. And Amazon is probably the most similar there to Tesla. And if you look from Amazon's cash from operations, since 2014, they've grown that from $6.8 billion all the way to $84 billion in fiscal 2023. But the reason why this is similar is Amazon spends a lot on capital expenditures, $52 billion last year. And Amazon currently reinvests everything into growing the future of the company, so they don't pay a dividend. Tesla is currently still in that phase where they don't pay a dividend, and they probably will be there for at least a decade. But Tesla, even today, still generates lots of cash from operations. With 15 stocks a page, they are on page 3 with $14.4 billion in cash from operations over the past trailing 12 months. But personally, I think Tesla will likely be somewhere on page 1 by 2030. And you could argue that sometime in the 2030s, they'll be up in this top group. So decades from now, Tesla will likely generate some of the highest cash from operations and the highest free cash flow of companies out there. And if they do that, then they would have the capacity to pay a very large and growing dividend. Under that premise, they could be the greatest dividend stock of all time. But that seems incredibly ridiculous to say today. And that likely will be ridiculous for at least the next 5 to 10 years. But who knows from now, this tweet may age gracefully in 20 to 30 years. So that's the end of my Tesla stock analysis video. If you enjoyed, please leave a like, comment, and subscribe to the channel. And again, if you want to use the research tool I showed throughout, then sign up at dividenddata.com. We're currently doing a 50% off sale so that as many of you can try my new AI tool as possible. Just use the promo code AI at checkout if you sign up via the web app, or click the link in the description and pinned comment to get the sale instantly. With that said, thanks for watching.